Bank reconciliation. What is it? A bank reconciliation is the process of resolving any discrepancies between the bank's cash balance and a business's cash balance at the end of a period. Why am I doing this? There are two main reasons for a bank reconciliation. Firstly, confirms the accuracy of both bank and business cash records as well as updates the business records. This is because the two records are compared. Secondly, it determines the actual cash balance that will be shown on the balance sheet. How do I make one? There are 3 steps in creating a bank reconciliation. 1. Reconcile the bank balance to the actual cash balance. 2. Reconcile the business's balance to the actual cash balance. 3. Adjust the business book balance to the actual cash balance, which is journal entries. Step 1. The bank balance. There are 3 reasons for discrepancies between the bank and the actual. Deposits in transit, outstanding checks, and errors made by the bank. Deposits in transit are deposits made by the business but have not cleared the bank as of the statement date. This is added to the bank balance as it is money entering the business. Outstanding checks are checks that have been distributed by the business but have not cleared the bank as of the statement date. In simpler terms, this is money that is leaving the business once the recipient cashes it. This is deducted from the bank balance. Errors come from differences between the business and bank records. They can be added or subtracted. For example, the bank may have recorded a deposit as $400 instead of $4,000. Therefore, $3,600 needs to be added. Bank errors are rare, but they do occur. Once all of those 3 are accounted for, the bank balance should equal the actual cash balance. To help remember, an acronym for step 1 is BAD-DO. Bank balance. Add deposits in transit, deduct outstanding checks, errors need to be accounted for. Step 2, the business's book balance. Theirs will differ for 2 main reasons: debit and credit memorandas and errors. A credit memorandum is a bank activity that increases the business's balance and is seen on the bank statement. This occurs when the bank collects cash from either a receivable or interest note. This is added to the balance. Debit memoranda are activities that are subtracted from the balance, such as banking service fees or insufficient funds. These should be deducted in the books as the business no longer has this money. Errors are also made by the business, for example, recording a deposit as $100 instead of $150. This deposit would therefore need to be increased by $50 in the books and added to the cash balance. Once errors, debit, and credit memoranda are recorded, the business balance should equal the actual cash balance. A mnemonic to help remember step 2 is, "Can Alice do splendid English accents?" which means credit memoranda added, debit memoranda subtracted, errors, and then actual cash balance. Step 3 is recording journal entries. These journal entries are the credit and debit memorandas and errors identified during the reconciliation of the business's book balance. Once all 3 steps are completed, you have finished the process and you have your bank reconciliation. Yay!